So you can also find out how much cash is collected, right? So this is the debit side, which is account receivable, which means you create your customer who yet have to pay us, right? So, and this side is the decrease in the account receivable, right? Which means we already received the cash. So how much cash is collected from the customers? We can also find it out by analyzing the account. We have beginning balance, we have ending balance. So ending balance is 5,000 more than the total balance here. So total balance is 60,000. It means the balance is 5,000 more. It means how much cash is collected? 11,000. Here it is, right? So this is basically accounts payable. I just pasted the answer here. Pause the video and try to understand this analysis. And now correcting accounting errors. So errors are logical. Yes. A human can do errors. Yes, because we are not machine. So accounting errors can occur even in computerized systems. Input data may be wrong, right? Or they may be entered twice, or they may be missed. So a debit may be entered as a credit, right? If something bad happened, if you increased a debit side, then how you can remove that one? You twice, you increase the credit side. For example, you mistakenly increase 4,000 on debit side. So you adjusted 4,000 on the credit side. So this 4,000 cancel, effect will be nullified. What if you want to put 4,000 here? What if you put 4,000 here, but actually you wanted to put 4,000 here, but due to error you posted on the debit side here. So all you need to do, you increase the twice size of the debit on the credit side, so that when it nullifies, your balance is still 4,000 greater on the credit side. This is how you basically solve or analyze or correct the accounting errors. So basically the missing account, trace each account from general ledger, right? You didn't post on the uh, mm, you missed some recording, you didn't post on the ledgers, and when you make trial balance, the the balance are not matched, equation is not matched. So it means either you missed some accounts. So you review the ledgers and try to put, for example, you missed the utility balance of 400. That means you go through and see the postings on the ledgers and try to copy the balance, and after that you find out that okay, we missed 400 utility bills. The next one is divide out of balance amount by 2, which means reversing debits and credits double the error, right? Like I just told you, if that was a credit balance 4,000 and you mistakenly write it down the 4,000 on the debit side, and it was actually the credit side, but how you correct the error, you add 8,000 on the credit side, so that's why it balances out. It looks like the strategy that you are posting 4,000 on the credit side. The last one is divide out of the balance amount by 9 if an integer or error may be a slide or transposition. For example, you want to write 72 but you write 27, right? So this is how you can just reverse the amount, and you can see that with which side you want to increase or decrease. Regarding charts of account, so as you know, the ledger contains the account grouped under these headings. So balance sheet accounts, assets, liabilities, and stockholder equity. Income statement accounts are revenue expenses. So organizations use a chart of account to list all their accounts and account numbers. So account numbers usually have two or more digits. Account asset accounts may begin with one, liabilities account may begin with two, shareholder account may begin with three. So this is how you number the accounts. So if you even don't know the name, if it is written 201, so you know that this belongs to liability side. So you just want to find out that what does this 201 mean. 201 means accounts payable. So what are the benefit of having chart of accounts? So you don't have to create an account. You are given the chart of account. You are given the list of the accounts. You only any transaction that occurs, you just see the chart of account that this transaction will affect which account mentioned by the company chart of accounts. Right? For example, cash may be accounted number 101, which is the first asset account. Accounts payable may be the 201, which is the first liability account. So we all basically num- uh, 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 we basically all numbered the account using the system. So we can also write it down. Okay, it's 1012 201. When you post this, it automatically triggered, and 101 means cash, 201 means accounts payable. Now here comes the basically an analytical skills for the account balances. So the normal balance of the assets, they must follow the debit balance. It's not hard and fast rule, but the normal balances are asset sides debit, liability credit side, owner's equity credit side, common stock credit side, debit side credit side, revenue credit side. The two exceptions, dividend and expenses, they must, not must, they should have their negative balance. So can expenses be in negative side? Can never. It means there is some kind of fraud or embezzlement or misrepresentation in an account if expenses are positive. Positive means that it will occur into the debit side. Debit side increase mean you have a cash in your expense. Oh, that is insane. And now analyzing transaction using only T account. Now, my question is, first transaction is occurred, we generalize the transaction and then we post into LE ledger, right? My question is, can we just analyze the transaction direct into ledger without going into the journal entry? The answer is yes. So sometimes decisions often are made without complete accounting system. Companies do not actually keep records in shortcut fashion, but a decision maker who needs information quickly may not have time to generalize or post the accounts and take a trial balance and prepare the financial statements. So a manager who knows accounting, they can quickly make the decisions based on analyzing the transaction. So here it is. So for example, the manager who of Whole Food Market Incorporation may consider borrowing 100,000 to buy equipment. So we are not necessarily to make journal entries because we are in a hurry and we want to see its effect, how it gonna affect or go directly to the T accounts. So first of all, number one, if you categorize this transaction into the possible one. First, he borrow the money and he buy the equipment. When he borrow the money, what happened? Cash Gonna increase mean debit side, so cash is increased, right? Borrow money means you create also liability because you need to pay back, so you increase the liability, and liability increase mean credit side you just added one. And you purchase the equipment. When you purchase it, cash decrease means the credit side sorry, credit side is 100,000, and equipment side, debit side is increased. So without further going to the journal entry and long process journal entry and then you post it, right? You can directly avoid journals and you just post it on the ledger. So managers, if they want to save time, if they want to make decision quickly, they can also just skip through the accounting process to generalize the entry and then post it. They can just go through the ledger and they can also make that one. Okay, we have successfully completed our chapter 2 and we have answered all our learning objectives. So I will be uploading assignment 2 on WeChat group, and I will also be uploading it on Blackboard. So please do respect the due date. So here is the end of the lecture. And if you have any queries, any ambiguity, any confusion left, please do write us in our WeChat group. And you can also post your queries in our Blackboard discussion forum, and students are, encouraged to answer those questions. I will be conducting Zoom live session as well to answer your queries. Okay, so take care, have fun, bye bye, see you next time.